And while he's getting settled, I think I'll just call up all the other panelists. We have the Chief Executive Officer, Digital Realty Nigeria, in the person of, so I don't know if it's Ike or Ike. It's both. Nnamani, round of applause as he makes his way up. And as you can see, Ike goes to the gym a lot. Ike likes pounded yam. Looking very fit, sir. You look like a whole data center yourself. All right. Next up is the program manager, network investments, Meta Platforms. Also, big shout out to Meta for being supporters, partners of this particular event in the person of Egomaron Jegede. Please, a round of applause. Okay, they're joining online. So, Mr. Jegede, if you can hear my voice, just give us a wave so we know who you are. Okay, can you do a backflip as well, just a somersault where you are? Okay, I don't think you heard that. We also have the Regional Industry Manager, Central and Anglophone West Africa International Finance Corporation, in the person of Dan Croft. A round of applause to Dan. Okay, Dan is just letting me know that he also goes to the gym. He goes as frequently as we have light in Nigeria. We also have the Managing Director, Xalam Analytics, in the person of Guy Zibi. I think he should be on the screen. How are you doing, Guy? I love the fact that you have the globe behind you. But I know that belongs to your 5-year-old daughter. I'm just spitballing. So there we have it, ladies and gentlemen. Please, the timer, the clock is on the laptop. That's to our moderator. So if our moderator looks across. So we have 30 minutes for the actual session and 15 minutes for the Q&A. I think this session is one that we want to get in as many questions and answers as possible. That's the whole point of literally the Convergence. So HCA Africa 2024. Dr. Coker, over to you.
Okay, thank you very much, and congratulations to the organizers of this event, Hyperscalers. Good luck, and great event, and look forward to it again next year. I'd like to welcome all the panelists. I think we've had a brief introduction of their roles, so I wouldn't use up much of our time to do that, and when the questions come, if you'd like to augment that, then let's do. So good day, everybody. This is Pan-African, so we have different time zones, and some people are still morning, some still afternoon, wherever you're watching us from. So I'd like to start. We haven't done a pre-arrangement or pre-discussion with the team, so this is going to be sort of free-flow view of individuals, and know the background of the individuals also. So I'd like to start with the with Guy, Guy or Guy, if you're taking a British. I asked him before, so that if you're taking an English or French view, so we'll take both since we're Pan-African and French and English mostly. You've done a lot of work on research on Africa, right? And the theme of this is, what is the right mix? As you look across Africa, what are you seeing as the possibility of the kind of emerging right mixes when it comes to digital infrastructure, funding and investment? What kind of locations, what kind of asset classes in digital infrastructure are you seeing from the analytics that you've done to date? And welcome on board. As to Guy.
Yes. All right. Sorry. I was on me. Apologies for that. So thank you for the question, and thank you for having me. It's a pleasure to be here. I must apologize for not being able to be there in person. but it's quite an honor to be able to contribute to this session. What is the right mix? I mean, it's it's a great question. I think I'll kind of pull back perhaps a little bit and kind of get a feel for the amount of capital that is required and kind of where we are, and then from there, we can work out potentially what mix of capital will be most adequate, depending on the type of investment that one is undertaking. If you look at digital infrastructure and really kind of the data center segment of the digital infrastructure space in particular, over the next 5 to 10 years, Africa as a whole, I mean, the data center industry is going to require around 1 gigawatt of new capacity kind of to be deployed around the region. So that's kind of the medium kind of 10-year target, if you will. In investment terms, in capital terms, I mean that translates to really anywhere between kind of $5 to $10 billion of investment, of capital that must be deployed to build this type of kind of data center and hosting capacity. I mean, this is commercial hosting. The challenge here, obviously, is that kind of across the continent, this is a business that is in kind of early stages of growth. Some of the businesses, some of the ventures are relatively new. I mean, they are less than 10 years old, as the case may be. That means that a lot of that capital will not be generated from internally generated funds, I mean, from internal cash flows, because the businesses are not yet generating kind of profits. So that capital will have to come in either through some form of debt or through some form of equity. So that's a significant amount of capital to need to build through debt or through equity. Now, what is the right mix of that kind of between debt and equity? I mean, that's really going to depend on the type of venture that one is considering. Is going to depend on the type of market. It's going to depend on the availability and kind of cost of capital. Ideally, most of it kind of comes through kind of equity, if you will, kind of being complemented by debt. But ultimately, the right type of mix, the right type of balance will depend on the nature of kind of each particular venture. So we can discuss perhaps later in other questions. I mean, what are some of the characteristics, perhaps that make one venture kind of more appropriate for kind of debt type of capital versus equity and vice versa. But for now, I just kind of want to give this kind of a little bit of a view of how much capital is required and how perhaps one must look in terms of the potential mix of capital that will be needed.
Okay, thank you very much. If we go to Dan now, looking at it from the investor point of view, how have you seen the development in Africa in sort of getting this mix of investments? There's equity, there's debt, and the source of those funds are quite diverse. There's been a significant shift in sentiment over the last 10 years. Pretty difficult 10 years ago as a data center infrastructure business looking for funds, but there seems to be a change in sentiment. And how do you see that developing? Not 0.12 of global availability of broad fiber, for instance, 1% of data centers, a demand for growth. But how do you see that, the way the investments are shaping up across the continent right now? And where do you see the best spots and the riskiest spots?
Okay, thank you very much. From our perspective, we're seeing fairly stable availability of financing. So I think over the last couple of years, total capex investment on the continent has been around 8.5 billion. From our side, in terms of commitments, and before I give the numbers, just to be clear, when we talk about commitments, our mandate as a DFI is both to put our own capital in, but also to mobilize third-party capital. And when we talk about commitments, it includes both. So things we do to bring in or make it easier for other people to invest, we call a commitment. That's a technical point, but I'll explain why in a minute. For the last couple of years, we have been averaging, I think, around $1.5 billion on the continent. It was slightly higher 2 years ago, slightly lower last year. But the reason I made the clarification is that 1 billion of that in the last couple of years was actually a political risk insurance product that we put together with our colleagues from MEGA, and that gave other people the confidence to put their money in. So I think that's one of the key things that we need to think about when we're looking at the sources of financing. The needs, I'm sure everybody has their own statistic. The one I've seen most recently has come from the World Bank, which talks about giving everyone on the continent access to reliable and stable internet. The capex needs are probably around $100 billion. And yet there's also been a study that has said that the contribution to Africa's GDP growth, were that to happen, could be as large as $180 billion. So you're getting a significant return at a continent level. You're getting a significant return on that investment. But clearly, one shouldn't agonize too much about the different sources of financing, because it's unlikely that if we all put our hands in our pockets, proverbially, that we're going to come up with 100 billion. So I think there's room for everybody. I think the key is for innovation. Guarantees will help. In particular, it will help deal with some of the things we've seen macroeconomically. Obviously, the Forex situation. Revenues are always going to be in local currency, and yet investments are largely going to be in dollars, at least until we can sort out some of the manufacturing issues that the last panel covered. So that's one innovation. We're looking very hard at what we can do in the guarantee space, helping mobilize local capital rather than ourselves, because we're fundamentally dollar denominated, and it's not that easy for us to be competitive and therefore helpful and to achieve the development impact that we want. If we're operating in Naira, we're just not that competitive. It's difficult. Something that we're trying to address. But I think the other area, I think we were talking about PUE earlier. One of the areas that we've seen massive growth is in sustainability-linked financing. So I think this now accounts for around 30% of our telecoms overall digital portfolio. But the idea behind that is to link financing. There are various pools of concessional financing that we can access, blend into our own to reduce the overall cost of capital. And usually that's structured in terms of an interest rate reduction over time as various climate goals are achieved. So for example, the more efficient you can make your data center, the lower your interest rate will be. I'm oversimplifying massively. But that's something which we can also look at to try and expand the various pools of capital that might be available to plug that $100 billion gap.
Do you see any general broad preference on which asset classes compare to activity, for instance, compared to data centers, or perhaps cloud providers, or energy producing investments?
I mean, as the name on the business card suggests, I cover infrastructure, so I was really interested in the power discussion. One of the things that we look at in terms of the energy generating assets that are required to help the digital assets grow, one of the problems we see with that is and when I say we here, it's not a personal preference, right? I'm personally in the kind of slightly less politically correct carbon camp. I think everybody should use the resources that they have. So the reference to gas earlier, yeah, I think Nigeria should use its gas. The problem is not all of our shareholders agree with that, and they're the guys who put up the money and also who approve our projects. So this dichotomy between climate friendly and non-climate friendly, investments and power sources is problematic. Simple fact is, yes, hydro's fine, it takes forever. The timetables we're talking about, I've been working on one in Malawi for over 10 years, and that hasn't even achieved financial close yet. So don't hold your breath for hydro. Solar, yep, fine, but as we know, it's not really that you can't dispatch it. So we end up coming to backup. And the challenge with that is if we're linking new power generation assets to new digital assets, from a lender's perspective, what we see is what we call project-on-project risk. We have to be sure that the person building the power station can deliver, and that the person building the data center has the demand to ensure that the revenues will be sufficient to repay our debt. So suddenly we're multiplying the risk that we're taking on projects, and it just makes everything that bit harder. So from our perspective, data centers, a big area of growth, but we have to watch the market quite carefully, because yes, there's masses of demand, but there's a difference between demand and bankable contracted demand. I can talk a little bit more about that. And also in the expansion of 4G and to a lesser extent 5G.
Excellent, thanks. So power, data centers, key areas of focus. And Ego, I'll come to you now from the networks point of view. And congratulations with the progress with 2 Africa, Gira on the East going live, and very much looking forward to the West coming live as well. And of course you have terrestrial investments around connectivity, and so on. How are you seeing this develop across Africa in terms of future execution, successes made so far, and where you see the opportunities, and where you can share with us? Fantastic to hear some of the perspectives, strategic perspectives of Meta.
Yeah, thank you, and thank you for the question. I think it's been fantastic to see the collaboration on a project like 2 Africa between various operators. I think on one of the earlier panels, somebody mentioned operator collaboration. So that collaboration between 8 partners, not only Meta, but MTN, Orange, STC, Telecom, Egypt, Vodafone, Wire, to come together as a consortium to fund 2 Africa over $1.5 billion in investment in infrastructure that covers, as you mentioned, the East Coast down to South Africa and the West Coast of Africa, and then connecting to Europe as well as to India.
Okay, great, thanks. And so what we see emerging as some of the tier 1, what we call the tier 1 countries, continue to emerge. And I'll hold the thought that, well, what about the tier 2 countries? We need to find a way of collectively scaling them as the key drivers for growth on the continent. Because I'm conscious of time, I'd like to get a view from an operator's viewpoint. Dan actually addressed quite a few of the question areas I was going to talk on. He talked about sustainability-linked loans. We're certainly seeing that. I think we announced something about 3 months ago, where we have done a lot of work on sustainability-linked loans and energy investments that you're doing, and so on. So thanks for covering those in that very comprehensive answer you give. So, Ike, from an operator's point of view, right, you've had a significant investment, you're seeing growth and expanding in multiple locations across the continent over here. And how do you see some of the growth opportunities with some of the challenges also? Dan talked about reporting dollars. We have currency issues across the continent. And we were seeing creative ways of that being looked at by the investors. So how do you deal with those ones with your investors? Because you have to sit on the hot seat.
Thanks. That's a good one. The reality is a very tricky situation at this time for 2 reasons. as you know, there's been some significant investments into the data center space over the last 3 to 4 years by global data center players, right? The good thing about that is they introduce a mix of funds that is not available locally, right? So for them, they are looking at their investment in Africa as part of a global investment, right? So if you take, for instance, digital royalty, which we are part of, over the last 3 to 4 years, we've committed about $2 billion into the African market, right? Now, that is not the kind of fund you would traditionally get locally here. Not from the local banks, not from equity investors and all that. It just doesn't exist, right? But they can do that because they have access to what we will call cheaper funds as part of the group, right? Equinix, the same, and some other global entities will have access to be able to get funding at, if it's debt finance, very low single digits interest rate, right? You can't get that here. Now, the biggest problem that is currently at play is what he also said, which is the forest, the currency, right? Look at it this way, and I'll give a very simple example. If you want to build a new facility, and you probably look at a case where 90 to 95% of the investment that goes into a new data center facility is forest. It's not local based, right? You have to import all the infrastructure and all that. A very tiny part of it is in the local currency, except you are building outside of Africa, right? Now, if you do that and you go to your investment committee and you do your financial modeling and you benchmark it in terms of, let's say, USD, for sake of analysis, let's say it comes to, for you to break even, you have to sell a kilowatt of IT load at, let's say, $500, okay? The numbers make sense. You've got users to take up the capacity. So it goes to investment. You got investors ready to put money, right? Now, if you come to Nigeria and at $500, you use an exchange rate of 1,500, for instance, right? To benchmark what you want to charge in Naira for the use of your service. That comes to how much, right? Now, you start charging your customers that in Naira. Guess what? If by next year, Naira depreciates to 2,000, and if you convert back what you've charged in Naira back to USD, you suddenly find out that you're no longer selling your service at $500, but you are now selling it at $300 equivalent. So your total business case, the basis where you got investment, 100% gets thrown out of the window. Not because the customers are not there, not because the metrics under which you went into the business was wrong, but 100% based on devaluation of the Naira, which unfortunately you have zero control over, because as a data center provider, you don't have any influence on what happens to the exchange rate. So this becomes a present day reality which every single data center or infrastructure provider whose funding is foreign based has to deal with. The only way around it is you benchmark your price, where literally as the Naira devaluates, you have to increase your price in the local currency. That is where the bigger problem is. You are dealing with customers who tells you, we can't afford it. It has gone high, right? So it becomes a chicken and egg situation where the only people and the only kind of funds that can sustain this are long-term funding, right? People that are looking at this and say, okay, hopefully over the next 5 years, things will stabilize. We've got a plan of 10 years to start looking at how do we claw back our investment. That is the only players and source of funds that will be able to sustain this. People that just want to, like the Nigerian banks, for instance, who want to put in money and get it back 2 years' time, it's not going to work. It's just not sustainable. It's just not going to work. So that is something that is presently the situation, and each company is trying to address it in their own way. My concern is, and this is a big concern, I think some of the data center players are going to run into big problem if they are not already in trouble, if their source of fund is not one of these key types that is long-term, very cheap, and can withstand some fluctuation in exchange rate. If not, a lot of companies will run into trouble very soon.
Yep, or pricing when not taking into account the realities of the issues we face as an industry. Actually, quite a few industries on the continent. Yes. So, short, long-term, patient capital, essential. The high-cost, short-term ones, don't go there. So, I'd just like to go around the panel very, very quickly. Africa, opportunity minus challenge, positive or negative? Ego, can I start with you? Thanks for the earlier comprehensive view of Africa investments. Opportunity minus challenge, positive or negative?
I'll go with my very personal as well as professional assessment. Positive, always positive for Africa, but not only in sentiment, but actually in statistics and data. When you look at the long-term growth, which a lot of people have mentioned here, I think Shia earlier, I know was talking statistics in terms of population, in terms of growth, in terms of the outlook for Africa, you can clearly see that Africa is going to be the region for great growth over the next few decades. Yes, there are challenges, and we've covered many of them, both from the policy and the regulatory side and the funding side, on the power side. But these are not things that we can't surmount, and there's so many examples used for Africa. And even local collaboration with people building fiber, coastal or even the landlocked countries like the DRC, we've seen changes and improvements by people collaborating to bridge gaps. And so I see so much opportunity across the continent, so much area and opportunity for people to collaborate, and that's why even within challenging circumstances, as Ike mentioned, Forex and interest rates, you still see foreign direct investment coming into Africa as a whole. So I won't go on so much, but I'm positive for you in terms of.
So if you're a rating agency, you're going for long-term positive rating. Guy, positive or negative?
I would say long-term positive, short-term a bit pessimistic because of some of the challenges that Ike outlined previously, and some of the issues that were raised around kind of power during the previous panel as well. But the long term to us is still fairly solid. There are just kind of a number of very systematic kind of structural trends that over the long term will not go away. You still have kind of a fairly deep kind of internet usage kind of across Africa, and that's deepening. You're talking 700 million kind of broadband customers kind of across Africa, and we are probably going to pass the 1 billion mark, by the end of the decade. That's substantial volumes in terms of increase of traffic. You have elements of kind of digital transformations and enterprises that are adopting kind of more kind of digital tools and kind of transforming, their IT setups. Those things are not going away. You have international kind of content providers, international cloud providers kind of bringing their services into Africa and building points of presence kind of in across the region. So over the longer term, I mean, all those factors will kind of help kind of sustain demand for commercial hosting services. So that long-term view, that long-term picture, hasn't really changed, and we believe it's going to stay sustained. The challenge is kind of surviving, as a business, until that demand reaches effective level, where it's not just kind of theoretical kind of potential demand, but it actually is revenue generating demand. You have to survive until that becomes effective, and you have to survive until that reaches a level of scale that allows you to generate revenue and return. And it's fair to say that this is really where it's been a challenge. Not just because of the effects and some of the macro kind of challenges, issues that Ike mentioned earlier, but also obviously because of some of the power issues, and also frankly because Africa, the adoption of some of these kind of new technologies, kind of around cloud, has taken a little bit longer than in some of the other regions, because, as was alluded in the previous panel, issues around trust, issues around kind of a mindset of building and managing your own data centers. So there's still a little bit of hold up in kind of externalizing some of those resources and using cloud services. So that work of essentially kind of selling those new technologies and services is something that takes time. It's certainly kind of taking a little bit longer than certainly we had anticipated. So that introduces certainly an element of risk over the short and medium term. So things are improving, but there's work to do. But to us, kind of the long-term view is still fairly positive. I mean, this is a region that needs and require a substantial amount of commercial capacity. So over the long term, the demand is going to be there. But obviously, one has to survive and make the business work, to get to that point.
So
the capital has to be patient. I mean,
short-term headwinds and graft, long-term positive. So maybe we'll ask investors to help change mindsets by not giving chief executives capital to build their own data centers.
So sorry to interject. We need to move to the Q&A very soon.
Rounding up. We're rounding up right now. Very quick one. Short-term positive, negative. You have 10 seconds.
Extremely positive long-term. Short-term challenging. Mid-term you get stability, but long-term definitely positive. And not just being optimistic. The data and the metrics all confirms that.
Anecdotal and factual.
Yeah.
And Dan, finally up to you. You said returns are good in perspective of the positive and negative.
Last word, thank you very much. Investment decisions, two things, right? You can look at the numbers, you can also look at the gut feel. I think most decisions involve a bit of both. The numbers, 180 billion of GDP growth, 100 billion of cost. Difference of 80 billion, there are challenges, but I don't believe they outweigh the 80 billion. So definitely positive on the numbers. Gut feel, I've been working on the continent, with the continent, in infrastructure for 20 years. Career-wise, everybody's telling me I should get some regional diversification, some sector diversification, but this is where it's at. If you're in development finance, the opportunity is, I would hesitate, nothing's unlimited, but this is as close to it as possible. Challenge is massive, but surmountable, so I'm a definite positive.
Fantastic. This is where it's at. So let's leave that thought for the future challenge discussions that talk about AI and stuff like that. This is where it's at, and the long term is positive. Thank you very much, panelists, and we'll go to questions and answers, please.
Okay, great work, Dr. Coker. Thank you so much for moderating that so well. Please, can you put on the multimedia screen the barcode for the questions? If you have any questions, feel free to scan the code.
Can I suggest two questions?
I agree with you. Can we have the microphone? So please, your name, what you do, who your question is addressed to. Nicolette, where are you? Is Nicolette around with the microphone? So we'll have the gentleman in front and the other gentleman behind him. So just your name, your question very quickly, and of course.
It's a matter of how quick you were on the draw. So I was the first one quick on the draw.
Who was quick on the draw? Oh, he got up. He's like, no, heaven no. This shall not pass me by. Very quickly, please.
There's another one.
Okay, my name is Wale Abu, and my question is directed at Dan.
Sorry, we can't. Sorry, we can't hear you.
My name is Wale Abu, and my question is directed at Dan. I want to know more about what you said about political risk insurance and guarantees. Does this tend to drive up the cost of funding for infrastructure projects here in Africa, or is this the same in other regions? Because I'm thinking if you take $1 billion just for political risk insurance, somehow someone will have to pay for it. Thank you.
Not sure I heard that perfectly, but
You mentioned something about political risk insurance, and would that not drive up costs generally for investments or those actually in receipt of investments? Did
yes,
I capture it right?
Undoubtedly, it's not free. I believe the premium is something around 1% of the sum insured. It can insure equity, it can insure debt. Can't insure our debt because it's a related institution and we'd be taking money out of their pockets and putting it into mine, so that doesn't work. So we have to take the risk, but others who might not otherwise come in can take a view and they can insure their risks. Not all risks, right? So there's certain categories, war, civil disturbance, breach of contract, currency availability, or non-convertibility, things like that. So yes, it undoubtedly puts the cost up, but so does borrowing entirely in local currency, right? Interest rates are much higher. So given that the pressing need is the shortfall in funding, every little helps. And my sense is if it doesn't make sense for a particular project, that investor either won't take the political risk insurance or they won't invest. And somebody else will need to find the money. So yeah, it's just the hard reality. Safer investments cost more.
Thank you very much for that. Well said. The other gentleman?
Good day, everyone. My name is Abdullah from Rack Center.
So could you speak up, please, well into the mic?
My name is Abdullah from Rack Center, Nigeria. My question goes thus to Mr. Dan. The data I have here with me, as of 2024, US has about 5,300 data centers. The Europe has about 2,300 data centers. Then coming to Africa, we have about 130 data centers. Those figures are too big for us here. How do I mean? 5,000 in the US, 130 in Africa. Looking at the investors, is there a trust issue in the African continent? Are investors afraid of investing in Africa? Or why do we have just 130 DCs compared to 5,000 in the US? Thank you.
So why do we have 130 data centers here compared to 5,000 in the US? I guess we've got 1.4 billion population against the population of the US, 300 and something million. Is there a fear of investing in Africa, or why that disparity?
In terms of a fear, I can only speak on our behalf. There's no fear at all. We want to do more. Infrastructure's the best resource department, and Africa's the priority region. We want to do more. The challenge for us, or there's lots of challenges, but one of the challenges for us is we can't do it all ourselves, so we've got to try and crowd in, mobilize is the word we use, mobilize third-party capital. That's our role as a DFI. right? It's not just to fund it all ourselves. We're supposed to be creating a market for investment and funding. So on any investment, we'll only ever take a maximum of 25% of any project, and that you can aggregate the equity and the debt in that if we participate in both. So we have to find other investors. From our perspective, one of the reasons that we're able to lend on usually more aggressive terms than perhaps some other dollar financiers is because we can borrow on better terms, and that's because we have a AAA rating, right? Our AAA rating is a function of our non-performing loans, and you can see where this is going. So we have to be quite careful. If we focus on the D in DFI, the development in the development finance institution, we'd love to take lots and lots of risk. So when somebody walks in saying, okay, I've never done a data center before, but I'm pretty sure I can do it, and I don't yet have any contracted revenues, but you know, you've seen that film, if you build it, they will come. That's quite difficult for us, because the dollars that that investor is asking for are competing with a whole load of other dollars in other sectors, which probably make more sense from an investment perspective. And we have to be quite careful not to distort the market, right? So we look at that kind of investment the way we would look at any other investment. Now, that then becomes a function of the market. So you've got, okay, the hyperscalers are here, they like to do their contracted, certain amount of pre-contract financing, which we are seeing increasing. And we're actually seeing terms come down to the point where we can't really compete anymore, which is, on balance, a good thing. Not for me, because I've got to find investments, but developmentally, that's a good thing. If people like myself are no longer able to compete, it means the money's coming from other places. But generally speaking, when we look at the investment propositions, you can look at the macro data and say the need is huge, and you can conclude, well, I'll finance every project that comes through the door. But we also have to have a look at whether or not we're going to be repaid. And we can't always say, well, we know the market's coming, it might be 20 years' time or it might be next year, but you know, we're that patient. We're patient, but we're not that patient. So we also have to show that our investments make sense, unfortunately.
Okay. Let me also add something here, because it's not always only about the money. And this is something we need to understand, right? For somebody to invest in a project, that project must exist. Now, if you look at the state of the digital economy in Africa, Nigeria in particular, it's still at its infancy compared to North America or Europe, right? Or compared to even South Africa, right? When you compare South Africa to Nigeria or across West Africa, right? So it's just in probably the last 3 to 4 years, you started seeing people really say, hey, we want to build data centers, we want to build this infrastructure. And it's only at that time that people start saying, come and fund us, come and invest in us, right? I remember some years back when we started, many people thought I was crazy. I kid you not. Many people actually thought I was crazy because they didn't see the need, they didn't see the value, they didn't see some of the stuff I was seeing some years back, right? So it's not only whether the money is there, but they also have to be projects in the digital infrastructure space before you go seek the funding. And in our case in Nigeria, it's the digital economy, if I use the date, the federal government, which was 2019, that they officially announced digital economy in Nigeria, is literally 5 years old. So we are still at early stage, but what I see also is, and this is what is more important, the rate of growth. If you check what has happened in the space over the last 3 years, it's more than what has happened over the past 20 years before that, right? So the rate of acceleration is extremely high, and we're going to see more of this play out in the coming years. I just needed to indicate that it's not whether they are scared of investing, but you need to have projects and infrastructure to even invest in. And it's very recently that these opportunities start showing up, and people that, in the words of the earlier speaker, are brave enough are beginning to go into it.
Okay, thank you very much. So short-term graft headwinds, please feel for those executives that have to deal with those. And let's look forward to the long-term huge upsides and returns. Fantastic. All the evidence and anecdotal evidence points to it, but we have to just deal with that political risk management and all of those things that we have to deal with to get those good upside outcomes. Thank you very much. Round of applause for the panelists. Great discussions. Thank you.
Thank you very much. Can we queue to those online as well? Okay, so thank you very much, gentlemen, for that. I think those are very brilliant questions, and even more brilliant, if there's such a word, responses as well. Very realistic and equally optimistic as well. Thank you very much. Once again, Dr. Coker, thank you so much for moderating that session. So well, a round of applause to them, ladies and gentlemen. Gentlemen, just a photo op very quickly before you leave the stage as we move quickly into the next session. For those of us who have questions, we'll put up the barcode again. We'll put up the barcode again so that you can scan and still drop your questions. And as you can see, there's a bit of networking that has already commenced. For those joining online, thank you very much as well. We will get to your questions as soon as we can. Our next panel session is on satellite, subsea, and terrestrial, Africa's path to seamless and integrated connectivity.